What would you do if earning $1 extra cost you $20,000 a year? In 2026, a married couple in their early 60s who lands just $1 over the ACA income limit can lose every dollar of their health subsidy overnight and owe the IRS thousands back on their tax return. I read the fine print so you don't have to. This is one of the steepest hidden penalties in the entire tax code, and almost nobody sees it coming. Around 22 million people buy coverage through the ACA marketplace, and in 2026, the old subsidy cliff comes roaring back for all of them. Over the next few minutes, I'll show you 3 moves. Pin down your income, simulate the cliff before you cross it, and adjust your income before year end, so this trap never touches you. Here's the number that should stop you cold. According to 2026 modeling from QuantCalc, a near-retiree couple can lose about $8,700 in subsidies from just $2,000 of extra income. That's roughly $4.38 lost for every single dollar earned. But here's the part nobody tells you. Cross the line by just $1, and the loss can be far bigger. 3 moves. Pin down your ACA income, simulate the cliff before you hit it, and adjust your income before the year closes. Each one is free and takes under 30 minutes. So, how does $1 do this much damage? Under the Affordable Care Act, premium tax credits, the main subsidy, cut off at 400% of the federal poverty level, a rule administered by the IRS and overseen by HHS and CMS. For 2026 coverage, that line sits near $62,600 for a single person and $84,600 for a married couple, according to healthinsurance.org. Below it, you get help. $1 above it, and every credit vanishes. Now compare the rules. From 2021 through 2025, enhanced credits under the American Rescue Plan meant no hard cliff. Premiums were capped at 8.5% of your income, even above the threshold, per healthinsurance.org. In 2026, that safety net expires. Above 400% FPL, your subsidy drops to 0, even if you're only $1 over. Same plan, same person. The difference is a cliff, not a slope. And there's a second layer that turns this into a debt trap. Most enrollees take advanced premium tax credits, paid to their insurer all year based on estimated income, then reconcile on their tax return. If your final modified adjusted gross income lands over the line, QuantCalc's 2026 analysis says you must repay the entire advance amount. The repayment caps that used to limit the damage are gone. On top of that, average ACA premiums jumped 21.7% in 2026, according to Medical Bill Rescue. Picture the 2 outcomes side by side. At $84,600, a couple in their early 60s pays around $8,000 a year in net premiums per Lumafin's modeling. At $84,601, $1 more, the full sticker price of roughly $28,000 to $30,000 kicks in, plus repaying last year's advance credits. That's a 5-figure penalty for a single dollar. Here's the belief that gets people. Most assume that a little over the limit just means a slightly smaller subsidy, that it phases out gradually. Under 2026 rules, that's wrong. It's a hard cliff, and crossing it by $1 erases 100% of your credits, adding $5,000 to $22,000 a year. eHealth QuantCalc 2026. Stack the 2 costs together, and it's brutal. That's roughly $18,000 in advance credits, clawed straight back to the IRS, QuantCalc 2026, plus about $100,000 in lost subsidies over 5 pre-Medicare years. Lumafin 2026. One misplanned dollar can cost this couple around $118,000. Let me show you how this plays out for one household. Meet Mark, 60, a self-employed consultant, and his wife Lisa, 59. They aim their income at exactly $84,600, the couple's threshold, buying a silver plan for about $8,000 a year, with 5 years to go until Medicare. Here's what Mark found. Discovery 1 is the $20,000 dollar. Mark realizes that if their income ends the year at $84,601 instead of $84,600, They lose every dollar of their credits, per healthinsurance.org and the IRS rules. For their age and county, that means premiums leap from about $8,000 to roughly $28,000 to $30,000 a year. Lumafin 2026, a $20,000 hit for a single dollar of income. Discovery 2 comes from a different source, the tax return. Mark learns the roughly $18,000 in advance credits paid to his insurer all year must be reconciled with the IRS on Form 8962. Because 2226 removes the repayment caps once you're over the line, QuantCalc's analysis says he'd owe the full $18,000 back, a surprise bill on top of full-price premiums going forward. Discovery 3 is the one that hurts most. Mark models being just over the cliff for the entire pre-Medicare stretch. About $20,000 a year extra for 5 years is $100,000. Lumafin 2026. And adding the $18,000 first-year repayment pushes the total near $118,000. QuantCalc 2026. One misplanned dollar quietly destroys 6 figures of their early retirement budget. Put it all on the counter. Across 5 years, ages 60 to 64, crossing the cliff costs this couple roughly $118,000, $100,000 in lost subsidies, plus an $18,000 advance credit repayment, Lumafin and QuantCalc 2026 modeling. That's an entire year of retirement income, gone to $1 of miscalculation. Could this be you? First, you buy health coverage on the ACA marketplace and receive a subsidy. Second, you don't know your projected income for the year within a few $1,000s. Third, you've never checked where 400% FPL falls for your household size. If any of those ring true, the next 3 moves matter. So let's fix it. These 3 moves work because they attack the problem in order. First, you find your real income number, then you see exactly what crossing costs, then you steer under the line before the year closes. Done together, they can save a household in Mark's position well over $100,000. Move 1. Pin down your ACA income, your modified adjusted gross income. It's not just your salary. It's your AGI plus non-taxable Social Security, tax-exempt interest, and certain foreign income per IRS rules. Then compare that against 400% FPL for your household. About 62,600 single, 84,600 married in 2026. This is general information, not personal tax advice. Here's how. First, gather your pay stubs, self-employment estimates, and investment and Social Security income. Second, start from your AGI and add back the non-taxable items the IRS requires. Third, compare that MAGI to 400% FPL for your household. Good looks like sitting comfortably below with real margin. Move 2. Simulate the cliff before you cross it. Use an ACA subsidy calculator built on 2026 data. Enter your age, county, and household size at income just under the line. And note your subsidy and net premium. Then change one thing, raise income by $1 or $2,000, and watch the subsidy fall to 0. The steps are simple. First, input your details at income just under 400% FPL. Second, record the subsidy and net annual premium, often $7,000 to $8,000 for a couple. Third, bump income up and note the new 0 subsidy premium. Good looks like knowing the exact dollar cost of the cliff. Before I get to the last move, which is the most counterintuitive part of all this, because it means deliberately lowering your own income, remember, this is the move that actually saves the 6 figures. Move 3. Proactively adjust income and deductions before year-end using IRS-recognized levers, like boosting pre-tax retirement contributions or deductible business expenses to pull your MAGI under the line. How to do it? First, check your year-to-date income mid-year and again in Q4. Second, if you're close, raise pre-tax contributions or deductible expenses. Third, update your projected income on healthcare.gov. If breakdowns like this help, subscribe. The next one's already coming. Why does this hit in 2026 specifically? In 2014, the original ACA set the cliff, capping credits at 400% FPL. In 2021, the American Rescue Plan temporarily removed it, capping premiums at 8.5% of income. And in 2026, the hard cliff returns. Above the line, subsidies drop to zero again, per healthinsurance.org. This is the year to plan your income carefully. Once you've acted, verify it. You should see a projected MAGA with clear margin under 400% FPL. Confirm your marketplace income estimate matches your real trajectory. And if year-end income creeps up, add deductions before December 31st. Everything here is drawn from the sources on screen. QuantCalc's 2026 repayment analysis, healthinsurance.org, eHealth, and Lumafin's early retiree modeling. The full links are below, so you can run your own numbers. You now know how $1 can cost a couple $118,000, and the 3 moves that stop it. Next, I'm covering the Roth conversion trap that quietly pushes early retirees over the ACA cliff. A mistake that looks smart until tax time. That one catches even careful planners off guard, and it connects directly to everything we covered today. If you want to catch it, subscribe now so you don't miss it.